Hi there, I'm Paul Bagnall. Welcome to Market Call here on B&M Bloomberg. Kim Bolton is our guest today. He is President and Portfolio Manager of Black Swan Dexterita. He'll take your calls, emails, and tweets on tech stocks, technology stocks in focus today with Kim Bolton. Call us toll-free at this number, 1-855-326-6266, or send us an email to marketcall@bnmbloomberg.ca. So those are the coordinates. You see all our social media information there as well. We'll get to your calls through the roughly 1 hour that we'll spend with Kim Bolton today. Kim Bolton, thank you very much for joining us. I think as a lot of our viewers know, you are an expert in technology stocks. Your company runs the Global Tech Hedge Fund, the BSD Global Tech Hedge Fund. We'll get to that in a moment. But first of all, you've told clients recently that you do expect an economic recovery. Larry Fink of BlackRock also telling clients today he expects an economic recovery, perhaps not as impeded by the typical obstacles that a financial crisis involves. What are your thoughts on an economic recovery? When and how sharp?
Well, thanks for having me today, Paul. It's sort of worrisome, isn't it, that everyone expects that this economic recovery to hopefully come sooner than later. Ourselves, we look at the price action of the market. We look at a lot of fundamentals, technicals, liquidity, and capital flows, and so on. Not quite sure how long this is going to last. That's why we still have a hedge in place. Currently, right now, we're about 82% fully invested. We have an 85% hedge overlay on the portfolio, and we've got just shy of 20% in cash. So we're not trying to time the market. We're just trying to manage and make some returns for our clients. And so far, knock on wood, it's worked out okay.
How recently have you made changes in the BSD Global Tech Hedge Fund?
Oh gosh, Paul, we make them every day. However, let me just sort of step back. Paul, we've done relatively well this year. We're up 16.5% year to date. But that, a lot of people ask me, how in the world do you make money in a market like this? And it's certainly not by trying to swing for the fences. It's just trying to make some singles. And we've been working on this for the past 5.5, 6 years. And so when we move into situations like we have right now, there's a lot of preparatory work that goes into it. For example, we went into last year, we're up about 10% on the year. However, we had this hedge that was in place because we were concerned primarily about valuations. You had a lot of tailwinds coming from liquidity and sort of momentum. However, the valuation really prompted us to increase our hedge out there, and then we stuck with it through the first few weeks of 2020.
I'm sure investors will ask you today about tech stocks that have been beaten down. When is the right time generally for investors to step back into some of these stocks?
Well, it's a great question, Paul. I would, we've never, in our portfolio, we've never been below 70% fully invested. However, we are very nimble and strategic and tactical when it comes to the hedge overlay that we put on the portfolio. So, our holdings, be it in single stocks and some ETFs, we sort of manage around it, but where we really get some alpha and protect the downside, but also more recently produce some profits and some alpha, is by being a little more nimble on our hedge. So for example, and I hope you don't mind me going on about it, going into the fourth quarter of 2019, the market kept melting up, and we had a hedge overlay on top of our stock portfolio. I didn't want to lose much money when it came on the hedging side, so we decided to, instead of adding to the hedge, we actually came in and we started to buy some put options. And put options, back in in December, when volatility was down 12, 13%, they were very, very cheap. So we actually went in and did 3 tranches of NASDAQ puts. And that is really where we ended up making a good deal of our money this year. We're now out of our NASDAQ puts, and we have our equity indice derivatives on top of our stock portfolio as we normally do. But it's difficult. I think it's very difficult for investors to actually say, well, where do I buy the stocks? You know, you buy stocks that you see a very, very long, lucrative runway out there that are leaders. And you know, here we are 10, 11 years into this bull business cycle. Most of our stocks are sort of medium to large cap that are leaders in their sectors and their categories, but it's the hedging overlay which is really, really important these days.
Okay, that is Kim Bolton. He will be our guest host for the full hour program today, Market Call. He's president and portfolio at Black Swan Dexterita. He's answering your question on tech stocks. Please give us a call at 1-855-326-6266. We'll take a break, and when we come back, your questions to Kim Bolton. Welcome back to Market Call. We have now questions for Kim Bolton. We'll go to our first question from our email inbox. James writes from Toronto. His subject is Infi Corporation, ticker symbol IPHI on the New York Stock Exchange. He writes as follows: I bought Infi Corp as a 5G play. A good move, or do you suggest something better? Kim?
Thank you very much for your call. Infi, we don't own it. We follow it, though. You know, Infi provides analog and mixed signal semiconductor solutions for communication companies and data centers and really for computing markets worldwide. There are some concerns. However, it's a well-managed company, but it's never turned a profit. The other thing that is a bit concerning, and we follow it very closely, is the debt-to-equity ratio. Normally, a debt-to-equity, you know, a healthy debt-to-equity would be, shouldn't really sort of exceed 40%. However, with the Infi, it's over 100%. Now, it is a good player in Canada when it comes to the 5G. Myself, where we look for the opportunities globally, and you just sort of spread your risk around the world into the 5G, is really into 3 groups, and they're big companies. You know, there's Cisco as a networking and switching company for the 5G networks, and then really the deployment people of either Ericsson or Nokia. Okay,
thanks for your question from James in Toronto on Infi Corporation. Let's go to the phones now for the first time in the program. David is in Truro, Nova Scotia. Hi, David.
Yes, hi. Thanks for taking my call. My question for the guest today is Facebook. Would you step in and buy it now, or do you have a better stock that you would buy? Just another question. I don't understand what you meant by like your overlay when you were talking about buying, having some of your stocks. Could you just, you wouldn't mind explaining that? Sure, appreciate it. I'll hang up and listen. Bye for now.
Okay, do you get all that, Kim? Your view on Facebook, or do you have an alternative? And I think he's talking about the hedge overlay that you mentioned.
David, thank you very much for the call and certainly for the question. I don't know you, but thank you for inquiring about the hedge. I'll get to Facebook in a second. So I've been managing money for the better part of over 30 years. The way I was taught is, number one, is capital preservation. And in other words, just don't lose money. And so the way we do that is by having this hedge overlay in place. So our forte is in the technology arena. And the reason it's in the technology arena is because our initial investors were very, very successful tech entrepreneurs. A lot of those original investors are part of our investment committee, and they give us great insight around the world where those long and lucrative runways in technology. And then we put on our portfolio and risk management hats, and then we go out and we build a portfolio of technology, publicly traded technology stocks, because a lot of our original investors were serial tech entrepreneurs. They have their own private businesses in technology, but they inevitably own publicly traded technology stocks, and that's where we came in. Now, getting back to the risk management side. So we hold a tech portfolio of stocks, and then we have entry points and we have exit points and price targets. And that's where we sort of gyrate between being fully invested and building up cash. But then to lower the risk of the portfolio and protect on the downside, and also lessen the volatility of the performance, we go out and we short equity indices. Our benchmark is a 50-50 NASDAQ Russell. So we use a lot of NASDAQ futures, equity indice futures, and Russell futures, but we also use other futures around the world. And there's a model for actually doing this. But currently, we currently hold about a 75% short equity indice overlay on top of the stock portfolio, because we're not sure whether the market is going to go up or whether it's going to go down. You go back a couple of months ago, we were very, very concerned about the market, and so we actually built up to almost 100% equity indices short overlay on top of the portfolio. Remember I mentioned those NASDAQ puts? And so we bought them cheap, but as they started to go into the money, that gave us even more protection. And so we use that overlay to, number one, protect the downside, because it's hard enough to make money, let alone lose money and try to make it back. And so, but it also lessens the volatility of the performance of the portfolio. And David, I hope I explained that correctly and it made sense. If it doesn't, I'd recommend you go to our website, and in the risk management side, it actually explained it. Now, on to Facebook. We don't own Facebook right now. We actually own a little bit of it, I guess, through the IGV and also through the FDN. Those are two ETFs. But as single stocks, no, we don't. We're still a little bit concerned about getting visibility into Facebook's earnings, and you know, in 3 weeks, sort of in 3, 4, 5 weeks, that's when all the earnings are going to come out. And that, we believe, is probably going to be the point where we'll bring down the hedge and we'll become more fully invested when we get more visibility of the bottom line and the top line of some of these companies.
Okay. Thank you to David in Truro, Nova Scotia, for his question on Facebook and the hedging that Kim uses in his portfolio, Kim and his colleagues use in their portfolios. Dave is in Toronto. Dave, what's your question for Kim Bolton?
Hi, thank you for taking my call. Basically, I want to ask about a company called Marvel Technology. It's a stock that I just became recently aware of, and they're like really affected from the 5G, and I'm not really concerned about short term because I'm a long-term investor. So I wanted to get Kim's opinion on this company, and I think it's a good 5G pick, but because American Tower is like really expensive, but this stock I think trades around 10 PE, and it's going to continue to grow. So I was just wondering, is this your 5G pick? Because it seems pretty attractive. Thank you.
Mm-hmm. Thanks very much. Great question. We actually own Marvel in an ETF, which is the SOXX. We use some of the ETFs really to be able to be a little more nimble in the market. On the single stocks, when it comes to the semiconductors, we own the likes of Infineon, Micron, but then, as I said, we have Marvel within that SOXX. You know, Marvel is a great company, and really where they got their legs under them is when they closed that acquisition of Cavium back in July 2018, and that really brought them to the table to compete with some of the big guys out there. And so they're a very, very strong leader when it comes to storage, into networking and switching, embedded processing, and they've developed some great relationships with some customers looking into the future, especially into this 5G deployment. You know, they've built some 5G momentum with Samsung, which is strong. They've developed a very significant partnership with Nokia on future 5G platforms. So, yes, I like it. There is some risk when it comes to the COVID-19 side of things, but as a single stock, I'd buy it. I might suggest that maybe you buy the SOXX, and then you'll be able to sort of spread your risk across that whole sort of semiconductor space, not only into the suppliers, but also the equipment makers. By the way, we have a price target on Marvel of $28.60 US.
Okay, thanks, Dave in Toronto, for your question on Marvel. We'll take a break, but when we come back, more with Kim Bolton, President and Portfolio Manager at Black Swan Dexteritas. He's answering your questions on tech stocks. Give us a call at 1-855-326-6266. We'll see you after this. Welcome back to Market Call. We're here with Kim Bolton, and we're on the line now with Peter in Vancouver. Peter, how are you?
Oh, thank you for taking my call. It's good to see you again, Mr. Kim Bolton the Great. May I have your expert opinion on Ericsson? You prefer this to AMD? Thank you very much, Kim the Great.
Good to hear from you again, Peter. That's a tough call between AMD and Ericsson. However, I think I'd like, you know, AMD is more of a tradable stock. However, I'd look at Ericsson as being a long-term investment. You know, both of them being involved in the chip side, but especially on the 5G deployment. And you know, the 5G deployment is going to play out over a number of years. And as I mentioned before, you know, the two big deployment groups are in Ericsson and Nokia. So, Peter, I'd go with Ericsson.
Okay, there's your answer, Peter. Thanks for calling. Let's come back to Toronto. Karen is our caller from Toronto. Hi, Karen.
Hi, thanks for taking my call. I just want to know if you own Constellation Software and if you think it's cheap right here, or would you wait for a drop-off? Thanks. Stay safe. Bye.
Thanks, Karen. We don't own Constellation here. As I mentioned before, in our stock portfolio, we have entry points, and we usually develop them in third as the market comes down. And then we have price targets, and we also sort of manage toward those price targets. And Constellation Software has been very, very good to us. And we took profit on it in the fourth. Well, it was probably the end of November, beginning of December. It'll be interesting to see how Constellation actually maneuvers through the next couple of months. As you know, Karen, Constellation Software, their investment thesis is by buying and acquiring very lucrative runway type companies, but at a discount. And certainly you have a number of those companies that are trading at a discount that I'm sure Constellation Software is looking for. So I wouldn't be surprised to see Constellation Software working very, very hard from home in actually assessing which companies they're going to actually be interested in. So it may be an interesting play, but I think it's a bit early right now.
Okay, thanks, Karen, for your call. Let's go to Deborah now. Deborah is in Okanagan Falls, BC. Hi, Deborah.
Hi, good morning. Well, Kim, thank you for working from your home for the viewers. We really appreciate it. I wanted to tell you that I was a bit brave and I entered Apple, Intel, and Google, maybe a bleat high during these times. But my question today is on Amazon. BNN had reported that there was a strike at one location yesterday. And so my question is, what is a good entry point at this particular point in time? I am a bit of a technical trader, and it's trading in the 1970 range, which is a technical resistance point. And I also wanted to know, what is your definition of partial entry? Is it always a third, and a third?
Thanks, Deborah. I'll try to remember all that you asked for. Amazon. You're right. This sort of 1970 to 2000 level is a bit of resistance up here. Amazon has sort of fluctuated for us between sort of a 3.5% and a 5.5% position. We haven't even touched it over the better part of 6 months. And thank goodness, it's tough enough to try to time the market versus trying to time individual stocks. When it comes to Amazon, I think a lot of people are now starting to realize it, and it's reflected in the price, the stock price, of how valuable this company is in good times and in bad times. And one area that we really see that is going to absolutely explode for them, remember, if you go back a number of years ago, it was all about the fulfillment side of things and then getting into international markets. But this whole just walk out, the Amazon Go, really plays into everything that's going on these days of how people can actually shop. They can shop online, or they can actually go to these Amazon Go. So we see this Amazon Go, or just sort of just walkout stores, as being sort of the next billion-dollar business, which is going to give it the legs to go for it to go toward 2,300. So I think, Deborah, you'll probably get a chance to buy it a little bit cheaper over the next couple of weeks. You've had a lot of window dressing going into the end of the month here, the quarter end, by a lot of pensions. And you've got earnings seasons coming up that is going to be a little bit worrisome to some investors. So I think you can probably get it cheaper. Now, just talking about the third. This is what I always say to our associate portfolio managers and our research people. I always like to do it a third, buying in and also exiting. Because, for example, buying in, if you buy in a third and it goes down, you can say, oof, well, I'm glad I didn't buy the whole thing, and then you get a better chance. If you buy a third and it goes up, you can say, well, at least I bought a third. And then likewise on the way up, sort of when we get within sort of that 5 to 10% of price target, that's when we take a third off. And then we take another third off when it gets up to price target, and then we start to evaluate whether our price targets should be actually altered. So that's why I do it as a third. I learned all that I used to manage a big operation at British Petroleum down in the U.S. We did hedging for their pension. We did it for for their balance sheet and so on. And that's where I sort of learned a third. You know, you can feel good going in, and if you don't, and it's impossible to pick a bottom, but it's a good discipline. Thanks for your question, Deborah.
Thank you indeed for your question, Deborah. We will take a break, but when we come back, we'll have past picks from Kim Bolton up next. Welcome back. It's time now for past picks. Our first past pick for Kim Bolton is Equinix. That's EQX on the NASDAQ. Recommended on March the 4th, 2019, just over a year ago, a year and a month or so, at almost $427 US. Trading now at 633. That is a return of 48% or a total return of 51%. Kim.
A winner. So it's getting pretty close to price target. We're watching it very, very closely because we have a price target on that of 675. You know, I look at Equinix two ways. Number one is this is space to be in, and you know, it's the behemoth when it comes to the data centers, and there's just this relentless growth toward cloud, and we're only in the early innings. But because they're so large, they have such competitive economic advantages, not only on winning deals, but also in keeping the costs down. But then it plays very nicely these days into this whole sort of work at home, the blockchain, the AI. So there's a number of reasons to be bullish on data center real estate investment trusts, which is what Equinix is. However, Equinix is the largest one out there. It's the largest one in the US, it's now the largest one around the world. And you can see when it comes to RFPs, proposals out there for companies that want data centers, that it's becoming very expensive to compete against Equinix, but therefore that's why it's priced so dearly up at this 640 range. So if you get a chance to actually buy it down in the 500s, I'd go for it. I'd be a little bit tentative buying it right here.
Very quickly, Kim, why has it done so well during this market meltdown? Is it its exposure to the work at home phenomena?
Well, Paul, that's part of it, but you know, you listen to the likes of, for example, Microsoft just came out over the last couple of days, and they said that their cloud revenues and growth had just absolutely exploded. But they use Equinix as actually a storage facility for a lot of their business coming out of Microsoft Azure. And so, yes, it's the work at home, but it's the whole Internet of Things. It's the AI side. It's the 5G. You know, it plays into all of those technology themes and trends that we all talk about as having those long and lucrative runways, and they are the biggest. You know, we were introduced to Equinix, oh gosh, 5-6 years ago, because one of our original investors has a significant data center out of the Middle East and through Europe.
Okay, we're going to move on now, Kim, to pick number 2, Tableau Software, recommended on March the 4th last year that's March the 4th, 2019, at $125 and change, trading now at $169.50, a total return of 35%.
We'll make this one quick, Paul. Tableau was actually bought back on June of last year by Salesforce. We actually had about a 3% position by the time it was actually bought. It was upwards of a 5%. So we bought it at $59.97, and then we sold out of it at 169.34.
Okay, we will take a break and we'll be back with Kim Bolton, President and Portfolio Manager at Black Swan Dexteritas. He's answering your questions on tech stocks. Give us a call, 1-855-326-6266. Welcome back to Market Call. We've got more calls on the line. Just before we get there, Kim Bolton, give us your take on Cisco Systems. That was the past pick number 3 that we didn't quite get to the last time around. A quick rundown on Cisco, and then we'll move on to our callers.
Thanks, Paul. Sorry, I was a little long-winded on the Equinix. Cisco, we have a price target of $53. You know, this has been a bit of a concern for investors out there, but there's some cyclicality to a lot of the earnings that goes on with Cisco, and so we're still sticking with it. We still see Cisco as being able to increase their margins. They're still going to be buying back their stock. They're trading at 13.5 times of free cash flow, so we still like it.
Okay, that's Kim Bolton on Cisco Systems, one of his 3 top picks in March of 2019. Let's go back to the phone lines now. Smita is in Woodbridge, Ontario. Hi, Smita.
Yes, good afternoon. Thank you for taking my call. I have a question about Tesla. Is this a good time to, like today is not a good day, but like after the earning, is it a good time to buy? Thank you.
Thank you.
Thank you for your call. Tesla. I find Tesla to be a very difficult stock to treat as an investment. I think it's a wonderful, wonderful trading stock, though. And it's interesting where it is right now. You know, it's stuck between its 50-day and 200-day moving average. The 50-day is right around 575. The 200-day is just shy of 400, around 390. Watch those levels because those will be very significant. And I'd buy them ahead of the 400 level and sell it upwards of 600. I would say at this point, I would really look at Tesla as being a hold. I could go into it a lot longer. We have a price target on it of 472. I know it's not near that right now, but I treat it more as a trading vehicle.
Okay, that's Tesla. Let's go back to the phones. Rui is in Mississauga. Hi, Rui.
Good afternoon. Thank you for taking my call.
Thank you.
My question's on Apple. Is it worth buying it now around the $260 price mark, or waiting for the first quarter earnings and seeing that it wasn't a great first quarter? Is there a better deal to be had then?
Yeah. Great question. Apple, yes, we own it. And we've owned it for quite a while, and we own a lot of the supply chain behind Apple. Buying it here at around, the 260 level, it really depends on your time frame. But if you're looking 12 months out, we have a 12-month price target of 330. So this is a great place to buy it. They have such a great balance sheet. They have a great franchise. And what I would recommend, if you're concerned about the earnings coming up, I'd use that a third. Buy a third here, and if it goes up, congratulations. If it moves down, then place another third in around that sort of 245, and then maybe down around that 230. And if you happen to get those 12 months forward, you'll be extremely happy.
Okay, thank you, Rui from Mississauga, for your call on Apple. We will take another break, but we're coming right back with Kim Bolton, President and Portfolio Manager at Black Swan Dexteritas, answering your question on tech stocks. Please give us a call. 1-855-326-6266 is our number. Hi, and welcome back. Let's go to Margaret, who's waiting on the line in Vancouver. Hi, Margaret.
Hi, how are you?
Good.
Thanks for getting my call. I just like to ask you for American Tower, which I understand it's going to be very good when for the 5G development. I'd like to get the advice. Is that a good stock to get, and where is the entry point? That is, at what price it would be good to get in? Thank you.
Margaret, thank you very, very much. Where would I get in? I'd actually, if Margaret, if you don't own it, I'd buy a little bit here because it'll get it on your radar, and then you'll follow it a lot closer, figure out how much you want to buy. If you want to buy $100,000 worth, then buy a third of it, 30,000 here. And if it goes down, you'll be happy to buy some more. Now, why do we like it? Obviously for the 5G deployment, but they're also, they're a leader when it comes to these towers, and they have the ability to actually continue to build out that leadership. They just bought Eaton Tower that brought in another 5,500 new sites. They're very, very aggressive in Africa. But even on the financial side, their annual CAGR is 10%. They have a decent yield of just shy of 2%, and they probably won't increase it this time around. They have increased it 8 of the last 10 years, but I wouldn't be surprised if they just sort of hold off. It's a great core part of your portfolio, Margaret.
Thanks, Margaret, for your call. Let's go to Calgary now, where Ram is standing by. Hi, Ram.
Hi. Strictly from a risk and reward point of view, Microsoft at $159, is it a buy at current price? Thank you, sir.
Thank you very much for your call. Microsoft, it is one of our top 5. It's probably number 3, I guess, in our portfolio. It's just one of those stocks that you really do not have to. You don't have to worry about it. It's got such strong cash flow generation. It's got a pristine balance sheet, fantastic management. It's got all the ingredients. But even in an economic slowdown in the short term, I think they'll actually manage very, very well. And certainly with the explosion in the cloud usage out there with their Microsoft Azure, this is becoming quite an annuity for them. So at 159, I would own it. And if it goes down, I'd buy some more.
Okay, let's go to the email inbox. John is our email correspondent. Subject is Datadog, DDOG on the NASDAQ. John writes as follows: could I please get Kim's opinion on Datadog?
Thanks, John. We usually don't play IPOs. We didn't buy Datadog on the IPO last September, but we bought it shortly after. If I recall, it IPO'd right around that sort of 33, 34, but then it came off pretty dramatically over the coming weeks. Got all the way down to 28. We have a price target on here of $48.60. This is one of our favorites, and we see this as being a pretty opportune time to actually buy into Datadog. Don't be greedy, because it is not a long-term hold. It is more of a tradable type of stock. Again, this is a company that is involved in the software as a service platform. It's involved in monitoring and fixing issues, automation, among others. So we like Datadog here.
Okay, thanks to those 3 callers. We'll take a break, and when we come back, we'll have his top picks, Kim Bolton's top picks right after this. Welcome back to Market Call. Kim Bolton is our guest. We are now going to look at his top picks. And top pick number one, Kim, is Micron Technology, ticker symbol MU on the NASDAQ.
Thanks, Paul. Just before I go through all these, just remember, we're in very, very volatile times. So as you buy into some of these stocks, I would recommend that you have some sort of risk management process behind you. That's what we do. We have a hedging overlay. It gives us the courage to actually own these stocks. And if they happen to go down, we'll make money on the hedge. So anyway, Micron. We love this in the semiconductor space. You know, and the valuation isn't so bad. It's trading at 5 times enterprise value versus EBITDA, so it's not very expensive. They just went through an earnings season, and they beat on all the estimates, even in a trying time. They've got it all covered, from the NAND to the DRAM to the 3D XPoint technologies. So they have all the ingredients. We got a price target on this of $63.
Okay, let's go to Shopify, number 2.
Yeah. Now, Shopify. Again, holy smokes, look at the volatility in this. You know, they reported back on February the 12th. We actually owned it back then. When they reported, we actually sold out of it at 578. And here we are back in the low 400s. And it actually got into the, mid 300s more recently. But we bought it again. Again, for those, I'm sure everyone knows about Shopify. It's just one of the poster childs when it comes to the e-commerce as a service, primarily for the small and medium-sized. A lot of people get concerned about Shopify because of the valuations. But you have to look at not the quarter or the quarter after, just what they have in the runway going forward. And they're going to be getting into the fulfillment business. They have tremendous opportunities on the international side. So that's why we like it, but don't get too greedy on it.
Number 3 is C Limited, ticker symbol SE on the New York Stock Exchange. It's an ADR, I believe. C Limited ADR.
Yeah. Thanks, Paul. We've been following this. We've been looking for the opportunity to get into it, and then finally, more recently, we did. So what they do is they're really involved in the 3 major structural trends that are going on in Southeast Asia. They're out of Singapore. And the sort of 3 legs of it is the online gaming through their company called Garena, e-commerce through Shopee, and then digital payments through AirPay. On the online gaming, they have this self-developed game called Free Fire. It's the 4th most downloaded video game in the world out of iOS and also out of the Google. So I'd suggest you buy a third of position here, sort of mid-40s, add in the 30s, and maybe down in the low 30s. So that's for C Limited out of Singapore.
Kim Bolton, it has been great to spend the past hour with you. Our viewers in particular have appreciated the chance to ask you questions. Have a great day.
Thanks very much, Paul. Appreciate it always.
Okay. As always, please consult a qualified financial advisor before making any investment decisions. Thank you so much for joining us. We hope to have you join us next time, and we will take a look at some market updates before we hand things over to Amanda Lang. There's the TSX Composite Index having a strong session, up 2.5%. Or 335 points to trade currently at 13,373 points. And as you can see, it has traded more strongly than that earlier in earlier in this early afternoon. You can see just after noon it was up almost 400 points and change. Let's go to the U.S. dollar. Actually, the big 3 U.S. stock markets. There's the S&P 500, the Dow Jones, and the NASDAQ Composite. Interesting to see those markets trading lower as the TSX tracks down from a sizable advance earlier in the daily session. Let's go to the U.S. dollar now. Track the greenback. The greenback has also traded into negative territory, back into positive territory, but you can see the trend is the same throughout the market world, and that is significant declines beginning at about noon Eastern time. West Texas Intermediate crude oil having a winning session today. It's up by 21 cents. That takes it to only, however, $20.31 US per barrel. Here's Western Canadian Select. All kinds of attention here on a unbelievably low price. It's trading at only $4.09. That's a drop of 4% or 17 cents. We'll finish with a look at gold before we say goodbye to you. There's gold bullion, the June traded contract in New York, down today by $30.50 to $1,612 US per ounce. Thank you so much for watching. Time now for Amanda Lang. See you later.